Forward Guidance is brought to you by VanEck, a global leader in asset management since 1955. You'll be hearing more about a VanEck ETF later on, but for now, let's get into today's interview. I am joined once again by Tom Thornton of Hedge Fund Telemetry. Tom is a veteran trader, and I want to be talking all things stock market. Tom, great to see you. How are you thinking about markets?
Well, I think we're starting to see a little bit of change happening, which is great because it's been, for active managers, it's been an actual nightmare because we just haven't had any dispersion in the market to find ideas. And there's pullbacks they don't happen. And we're starting to see that develop. And I that gives me encouragement going forward. I should actually preface that and say we really haven't seen enough dispersion. In other words, we've been sort of skewed by the S&P and NASDAQ lifting higher and led by, it's been talked about 100 million times, 5 or 6 stocks doing all the attribution on the upside. So we're starting to see some changes happening there. I caution people that the rotation trade that people are, loving right now most likely will turn out to be not as good as they had hoped. And that's the concern I have right now. I'm bearish in the market, blah, blah, blah. I have longs, I have shorts, I have a long short fund. But I do think that we're starting to see peak tech start to occur.
And so the stocks that have led the market this time, Nvidia, Apple, Google, why has that been hell for active managers?
Because people are looking at performance and saying, well, you're underperforming the S&P. And yeah, I have, and I'm fine with that. I'm not fine with it, but I'm cognizant of that. And the last 2 years have been tough for those that haven't chased those technology stocks that are trading at excessive valuations, very bubble-like and thematic-like with the AI narrative that we can go into a little bit more after this. But I think that the last time we had this type of performance or underperformance by active managers, and really it's been underperformance by the majority of stocks within the market versus the S&P, was 99 and 2000, and maybe it was 98, 99, but we had 2 years in a row where that happened. And I saw some data recently that showed that only 24% of the S&P has outperformed the index, and that is exceptionally low. And if you took out tech, which only 42% of the tech sector was outperforming the index, it was even lower at around 17%. Now you're starting to see some rotation. The banks are starting to act very, very well. And I personally don't think that I want to be involved in banks if we do go into a recession, which I think is possible. It's always been the waiting for Godot for a recession for so many people that have predicted it. But I think we're probably going to see a recession in the next year. And especially if the Fed starts cutting rates, they're going to see a recession on the horizon.
And you said earlier you think that this market is a bubble. What about this market is bubblicious to you?
Going back and perhaps comparing 1999 and this year, there's a lot of comparisons. One, you've had this, narrow action with leaders such as Nvidia. You can add Microsoft, Apple, Alphabet, Amazon, Tesla. This partly in the last few months into this mix, and I think that going back and people always talk about, oh, it's the dot-com bubble. Well, it really wasn't 99 being the dot-com bubble. It was this mad scramble to avoid the Y2K problems that so many people feared because There was some code that, thinking back, that it wasn't going to be able to recognize the year 2000 and everybody's computer was going to blow up. And so everybody went out and rushed and bought new computers, upgraded their networking equipment. That was just a mad scramble. And I think that that's seemingly happened again with AI. And when you think about AI, you have to think about the picks and shovels, very similar to Cisco. And everybody said, oh, Cisco's PE was so high, it doesn't compare to Nvidia, which Nvidia trades around 50 times earnings, which isn't cheap. But Nvidia trades at a price to sales over 40 times, and that is expensive. And I believe that is the highest in the S&P. So with that in mind, what happened with Cisco was that they had great earnings. They were selling networking equipment to all the telecom companies, banks, just all over the world, which they need to upgrade their systems again for Y2K and for the internet that was, blowing up and really was a much wider scope of companies that benefited from it. But then what happened is that you started to see a bit of pullback on CapEx. And when that happened, Cisco and others, specifically a lot of semiconductor companies that supplied to Cisco, started to say, hey, oops, we're going to miss earnings. And that, I think, is going to happen again, perhaps with Nvidia. We're going to see growth, but it's not going to be hyper growth like we've seen. It's going to continue to grow, but it just may not grow as fast as some people anticipate. And when you think about Nvidia has gained about $1.5 trillion in market cap since April, I give you, that is fairly extreme. And so we're seeing a pullback from that. And I think that it gets to a point where it's super crowded. And that leads me to another issue, crowding. Everybody's in this market. Retail is fully long. Every sentiment poll is at peak levels. It's moderated on a few in the last week and a half. But investors' intelligence is at 64% bulls. And when it gets above 55, they start to get a little nervous. When it's above 60, they call it the danger zone. So people are complacent in this market. And I don't think shorts are that involved in the market as well. You have CTAs, which if you look on all the different prime brokerages, they're fully long. The vol control funds, which have seen huge inflows, and those are the vol sellers. And they've been selling vol at really cheap valuation, or low vols. That I think is another risk in itself, because if things start to unwind, those funds get caught out pretty quick. So we have really basically everybody's in, and I think that the narrative has been this. I guess the Fed has dangled the carrot in front of the donkey, and the market has just chased that. Oh, they're going to cut rates. They're going to cut rates. And inflation really hasn't moved down in the same magnitude that it did a year ago. And the risk is that you have base effects going forward that could show inflation remaining sticky, possibly increasing. And I had a conversation with my friend Julian Brigden, who I think he's in a bunker right now, because he was telling me, he's like, Tom, and he speaks in this good British accent, Tom, people are not ready for this. If inflation starts to tick higher and the Fed, which has basically telegraphed that they're going to cut in September, if they cut and inflation starts to tick higher, the market's not going to know what to do. And I think that if they do cut, it's not necessarily going to be a big rate cut cycle like we've seen in the past. And one or two cuts from these levels really isn't going to make much difference in the grand scheme of things, because in the grand scheme of things, the high interest rates that they haven't really done anything either. So I think it's just going to come down to earnings and moderation in earnings. And that, I think, is going to be an issue. And it's also a game that Wall Street plays with expectations. Expectations for the tech names have been really, really high, and if they don't match those expectations, they could have still good growth, good earnings, but if it's not as great as they want, good is okay, but great is what the market expects, then we could see some moderation in the equity markets. And that, again, that would be welcome to me, because I do best in markets that have some volatility, that gives me the opportunity to buy things on pullbacks. But when it's just going straight up, and I just don't chase it. It's just not in my DNA to do, as much as I wish I did. But it's just not something I do with my process.
You said many things, Tommy, that I will absolutely grant you. This market is getting crowded. It's a lot more crowded than it's been since 2021. And I don't think the shorts are really having a play at all. I mean, there's not a lot of shorting in this market. But when it comes to Nvidia's, I'm not going to talk about any other companies, but when it comes to Nvidia's growth rates of its revenue, has there ever been a company this big grow its revenue this much? Like 260% year over year. Is there some merit to the furious rise in the share price?
Again, in the .com bubble or the Y2K bubble, you had a lot of companies that were growing revenues at pretty excessive rates. Nvidia is really unique because it really is the only game in town, and to their credit, and they've, the stock's gone up so much in market cap. I think that's a big risk as well, because if you have a lot of, if it's almost a $3 trillion company and it goes down $1 trillion, that's a lot of losses for people. But I think it's fairly unique, and you can look back, you can look at some other names. Look, I'm just looking at my screens. AMD's at 140. It was, I think, a lot higher before, and they are a competitor. Intel hasn't done anything, so Nvidia really has the sort of the lead on. Well, I don't want to say lead, because I think everybody else is sort of left behind. They're the only game in town, and if Microsoft reports next week, I think it's going to be really important to watch, because you really haven't seen the earnings through their AI initiatives show up. And that's true with a lot of other companies. You have a lot of announcements that you're going to do, Oracle, they're going to collab with Nvidia. Oh, great. It's going higher. But Microsoft really hasn't shown the AI earnings yet. And if they come out and say on their conference call that perhaps they're going to, accelerate their own chip making, that I think will be a risk. If they say that they're getting fully built out with their data centers, that's going to be a risk. And Meta as well. They went down because they said they were going to increase their capex, and if that seems to change in the next quarter with some of these other companies that are really the big spenders and the top, front of the line with Nvidia, then we're going to see, some pullback. But again, you really haven't seen, like, in the internet bubble, everybody was moving to the internet, and you had a much wider adoption of companies using the internet, and it helped them create scale that they've never had before. I mean, the Gap opened up an internet site, and they didn't need all the stores that they had, because people could buy online. And that was basically every company. And there were a lot of new companies that came on. But again, I think that you have a really extended market with valuations that are historically high. I think Microsoft, I looked at it recently, it was trading at 38 times earnings. That's high for Microsoft. Apple is up there as well. It was around 35 times earnings. I was short Apple. I covered it when it was at 25 times earnings, and I added back when it was around 30 times earnings, because that's kind of the range it's been, but it's moved higher. And we've seen this huge last surge in prices that's more multiple expansion versus earnings growth. So I think that's a leap of faith on investors that are chasing this market higher and forced into the market. You have a lot of fund managers that have to be long these stocks to keep up. I haven't kept up. I've tried to look for more, esoteric or non-correlated ideas on the long side versus the stuff that I see as overbought.
What are you going to see in terms of earnings? Because share prices have gone up definitely more than earnings and earnings expectations. But how are you assessing the odds that actually very, very solid earnings do come in? I mean, we had Tesla's earnings, and that was an unmitigated disaster. I think that even the sales went down year over year, let alone the profit. But Google just reported, and their revenues were up 14%, and their profit was up 28%, and that's a pretty healthy growth rate. How are you assessing the odds that all of these other companies, the big tech companies, they come in with very strong earnings?
Well, Alphabet was trading at highs, and I think the nitpickers looked at a bunch of different things that, metrics, YouTube was a little light, or I'm not sure all the details right here, but I think that they looked at certain things that they wanted to see as great. So their earnings were very good. And I'm thrilled that it's moving lower, because I think that's one of the go-to names that I like to buy when it does pull back. I think Tesla, which I've been short, I covered some in my fund at around 140 ahead of the last earnings, which I anticipated to be an unmitigated disaster, which they were. The problem is that Tesla people are believers in whatever Elon Musk says, and he's tried to, turn the narrative towards robots, AI, robo taxis, things that are more moonshot in nature versus selling cars at a decent margin. Tesla's got a real problem on its hand because they have older cars that haven't been updated. They had a rumored Model 2, more affordable car that looks like that's done. They shelved that because the Chinese are eating their lunch. And I think that the Stellantis CEO yesterday on Bloomberg said that they have a 30% cost advantage versus other legacy automakers. So it's going to be tough for even a Tesla to come out and compete with the Chinese. So I think, again, I remain short Tesla. It's been one that I've had. I trade around it, so it's not like, I've been short since 2012, and I'm hoping it goes back to 2. But no, I trade around it. I think that it's going to be very tough for them in the next year with no new cars coming. They keep promising robo taxis. I see that to be.
They've been promising that for a while, a very long time, going back to at least 5 years, probably longer.
Yeah, that's the thing about Tesla, and they get this free pass on, saying, oh, we're gonna come out with a roadster, and this is like 2018 or 19. It's still not out. People put down, huge deposits on this, and it's not out. The million, Cybertruck placeholders that people put $100 deposit on, a free gift to Tesla for raising capital. I don't see that really as a needle mover. I think that's a loss leader. It's kind of a ridiculous looking car, to say the least, and not easy to produce, not easy to fix. If one crashes one, it most likely is a total. Insurance costs are really high on those. But I don't see them producing robots that will take this to, an absurd valuation that Elon talks about. I don't see that being anything that people really need right now. I don't see any of that happening for in this decade, let's say that. And, the other thing about their self-driving, we'll know that it works when they say, we will indemnify the user for robo-taxis or full self-driving because that's what Waymo's done. They take the insurance liability for their robo taxis, and if Tesla does that, then we know that they have something that works. I don't believe that the Tesla hardware on the cars currently, just cameras, is enough. I think that Waymo has, the radar, the lidar, all the other stuff. So I think that you may have a robo taxi that comes out from Tesla, but it's going to have a lot more goodies on top. They're sort of doing it backwards, because in technology you used to have these big, you put more stuff on a product, and then as time goes on it shrinks down and makes it a lot smaller, just like a phone. The first cellular phones were these big, bricks that they had. Now you can have so much more in such a smaller package. So they're kind of going at it the wrong direction, in my view.
Forward Guidance is brought to you by VanEck. The VanEck Morningstar Wide Moat ETF, ticker MOAT, has outperformed the S&P 500 for over a decade. How? Moat strives to achieve a simple but challenging task: buy quality stocks when they're undervalued and sell them when they're overvalued. Visit vaneck.com/moatfg to learn more. That's vaneck.com/moatfg. Now the disclosures. All investing is subject to risk, including the possible loss of money you invest. Visit vaneck.com to carefully read a prospectus before investing. The VanEck Morningstar Wide Moat ETF is distributed by VanEck Securities Corporation, a wholly owned subsidiary of VanEck Associates Corporation. Thanks. Let's get back to the interview. So, Tom, I take it you don't agree with the ARK forecast of that Tesla's going to go from $250 a share to $2,600 by 2029, and the bull case being 3,100 and the bear case being 2,000. Tommy, I want to ask you just that ARK ETF, which is hold companies that are involved in disruptive innovation. Another way to say that is speculative companies that don't have earnings or don't have a lot of earnings and trade at very expensive valuations. That ETF is still down 70% from its highs from 2021. So I might offer, and help me understand where I'm wrong, that I think that this kind of market feels different than 2021 because you're not having speculative companies with no earnings and only pie in the sky dreams leading this market. ARK is not up. All the money is going to Nvidia, Apple, Broadcom, as well JP Morgan, and many other companies that, whether you think they're overvalued or some could say overvalued, undervalued, they have real earnings. They've been around for a long time period. What are your thoughts on, do we need to see more bubblicious behavior and more money flood into very speculative stocks before this so-called bubble that you say pops?
Well, my view on ARK, I was short that. I'm still short, but I shorted it around 140, and I took some profits of course, on the way down, but I remained short. I think that Cathie Wood got really lucky in the sense that she predicted that Tesla's stock price was going to go up by X amount and hit her price target. I think that was partly due to the speculative nature of the market, the gamma squeeze, which that's a whole nother topic. And nothing in her thesis was that came true. Her whole thesis was robo-taxis, and that's back in 2020. Those never came out, and we still don't have full self-driving that truly works. It's gotten better, but certainly there are others out there that have a lead on Tesla. But I watch the outflows for ARK. You've seen 7 months in a row of outflows, and you still have a lot of people that lug that stuff from those times where it's 2-3 times higher than where it is now. And I just don't think that Cathie Wood really has a grip on things. And if she's really disruptive, well, she missed Nvidia big time. Well, she wasn't long, and that I think is to her detriment, because that was absolutely if you're going to be disruptive and innovative, Nvidia nailed it and crushed it, and that's been a big miss on her part. Now she got Coinbase, which I think that's more speculation in itself as well. I don't think that they're necessarily super profitable. I don't think that the ETFs are necessarily all that great for the crypto market. That's my view. People can have their own view of crypto. It's just not something I study it. I study the price action. I think it's a bit toppy. Again, you really ARC, things like that. It's all sort of faith based, and you have faith in the future that this is going to be something great. And there's really nothing behind it that you can look at it and say, oh, well, the earnings are this, or it's valued based on this. I know that there's a lot of people that will say, oh, Tom, you just don't get it because there's a limited supply. And I get that. But I think there's just way too much speculation in that. And we're not at 2020, late 2021 speculation. But if you go back to 2021, a lot of the speculative stuff really started to peak early in the year, ARC as well. And then the mega cap names really took over. And, I look at stuff from a technical point of view. I look at sentiment, stuff like that. And the NASDAQ 100 using DeMark indicators, they have sell signals that have triggered, not necessarily just on the daily signals, but on the weekly. And that was a similar occurrence that happened towards the end of 2021. Positioning also was really, really high going into the end of 2021. And what we've seen I just read from Morgan Stanley and Goldman is that there's been degrossing happening. In other words, funds are taking down exposure on both the long and short side. And that was something that really was concerning to me at the end of 2021, 2022. So I think people are the funds are getting a little bit more concerned than individuals out there. And I have CNBC on behind me. I never turn on the volume to save brain cells, but I think that it's always a matter of bringing on the same people that say the same thing, that always have some bullish slant. And I'm happy to have more of a equal weighting, thought, like, okay, well, what's bullish, what's bearish? And I try to put myself in the position of what are the bulls thinking if I'm short something, and what are the bears saying if I'm long something. And sometimes I don't get everything I want when I find an idea that I am looking to do, but if I can get 75% of everything that I need, not 100%, but 75%, I'll do the trade. It's funny because on X you can really get an instantaneous sentiment read on an idea that you have. Like recently, when Nvidia was a bit higher, I added it as a short idea on our trade ideas sheet, and I shorted it in our fund. And I always get this, the people that will say, "Oh, good luck," and those you're going to lose a lot of money on this one. And if you look at the chart and you look at a weekly chart of Nvidia and you think, "Well, man, you're going to lose a lot," you're kind of missing the picture, because sometimes when things have moved so much and you have exhaustion signals that I tend to think work, and if they don't work, you have a fairly good idea of when when to stop out. But I had a lot of people say, "Oh, you're going to lose a lot of money on this one," and I took it off just the other day, and I don't mind booking a 10% gain on a short idea within a week or two. It's not that easy to do. So that's kind of the instant sentiment read you can get. And sometimes on long ideas, I'll put a long idea out there and I get the same good luck. And then that's sort of my good luck charm, and someone sarcastically will say something like that.
So you made money shorting Nvidia. I imagine of the shorts of Nvidia over the past year, you probably are breathing pretty rarefied air, because a lot of, just looking at the chart over the past year, the shorts have lost a lot of money, and 1%, 2% of the people who've been short that name have made money, and congratulations to be
Well,
one of them.
I don't short it often, and I don't just sit there shorting Nvidia often, or just sit there passively and say, it's overvalued at 40 times sales. I'll find spots. And the previous time that we had DeMark signals, the last two times, it went down 20% and it went down 10% the previous two signals. Again, it went up after that, but still, I picked off a couple places where I could see as a decent place to short it.
And where do you think Nvidia is headed over the next year?
Well, I'll say this, and I caveat it. I could be absolutely wrong, but I think Nvidia's made a long-term top, and a long-term top where it may not surpass this level for a long time, and it could be a something that I'm wrong in within 2 weeks. I have no position in it right now, but as if I look back to the way Cisco traded, Cisco made a long-term top that still hasn't hit that same level to this day, and that was, I think, in 2000. So we'll see. But again, if growth isn't great and hyper growth, the stock could sell off. It's crowded on the long side. I think people, again, fund managers have had to own this in larger size to keep up with the indices. And if that falls off, then this thing could move to maybe, I've talked about like the 80s, which is still extraordinarily elevated, but each point, I got to remember this, each point is $25 billion in market cap, each point. So each penny is $250 million in market cap. So if it goes up 4 points, you're looking at, $100 billion in market cap, give or take. And that seems, that for some people, that may seem, well, wow, that's so what? But to me, if it moves 10 points, you're looking at a fairly decent market cap decline, bigger than Cisco's at its height, in a little bit more. But still, I think that's the risk here. And I think Warren Buffett, in his latest note or shareholder letter, was inferring that some of the market cap expansion has given him a pause on certain things, and even like Apple has moved up again. That I think is sort of going to be a dud, because they're coming out with the AI initiatives, and
Apple Intelligence.
yeah, and it's not proprietary to them. How much they're going to make from that is to be determined. Again, I go back to the Microsoft, where, how much are they really making? Adobe, how much are they really making? Because that was an AI darling as well, that they would, see this huge increase. But I think it really just comes down to how many phones they're selling. And are their phones really, there's always the Dan Ives, on TV saying, oh, it's this super cycle that's coming and everybody's going to upgrade. Well, if the consumer's starting to slow, which we've seen numerous places where the consumer is slowing, from they're not buying as many Teslas, they're not buying Nikes, Starbucks is under pressure. There's a bunch of retailers, high-end retailers, that are starting to show signs of weakness. Are people really going to need to go out and upgrade their phone? They made a mistake, in my opinion. They should have said the new phone is going to be the only one with the AI capability. And they said, oh, all the phones are going to use it. So I think that they could have had this big upgrade cycle if they had something proprietary on the new phone. It's just, I mean, I think we can guess that the new phone's going to look fairly similar to the old phone, and it's expensive. It's expensive, and a lot of people are using the buy now pay later, uh, you know, using that to buy the new phone and upgrading it that way. I just don't see this giant need to upgrade phones. I mean, in the old days, remember when there were lines around the block at Apple to get the new phone or the new iPad? You just don't see it anymore. And you have a huge installed base. Apple's a great company. I just think the stock's overdone here.
Stock's overdone. Yeah, I have to get an. I'm in the market for a new iPhone. I think I will be replacing, but got a sample size of one. So you don't think that the Apple Intelligence will boost their sales that much?
It could, but I don't think it's going to be a needle moving type of product at the get go. I think it's going to be something that's going to develop over the years. And a lot of the AI stuff, I think a lot of software companies had this type of technology. A lot of hardware companies had this technology, and they've really sort of rebranded it as AI. And just because, if you say AI on your conference call or you make an announcement, it's AI, then, lo and behold, your stock goes up. So I think that it'll be interesting to see. Siri's been really crappy, as we all know. It doesn't really do much. So there can be improvement there. But I don't really know if I'm spending more money uh, using that. I'm not sure if I'm, giving them more money if I'm using a better Siri to get answers on things. And a lot of the answers that you get with the, Chat GPT and others are sort of boxed in, lame answers that you just have to go in and you're going to say, well, yeah, it's good. You got a lot there, but you got to change a lot. I think it's still a work in progress.
It definitely is. Yeah, Apple, its revenues and its profits grow in cycles, so it does have periods where they have been flat, and the revenues have been flat since 2022. But we could be coming up to a new cycle. So, Tommy, what are you bearish on specifically? What stocks are you short?
I'm short ARC. It's boring. I am short. I'm short semis with SMH. I'm just going to kind of give you the basics here.
That's another one that's just up a ton, and it's
Yeah,
a sponsor there.
I
That's
added to it
number two.
higher, so that was good. I'm short. I'm short John Deere, and I shorted it after the last earnings higher. I recently added to it. I was short Caterpillar, and I covered that lower, and that I want to add back. I'm hearing there's a lot of inventory in the system, and that I think is going to be, those are going to be places in industrials that are going to be okay to be on the short side. They're not cheap. They've had big runs, and any sort of hiccup or high inventory, then things get slippery on the downside. I'm short Netflix.
Mm-hmm.
I shorted that higher, and I held that through earnings, and that was fine. Some indices like XLI, which I think is okay to short.
Industrials ETF.
Yeah, it's up today with Triple M. That's up, but that's kind of where I'm at right now. I'm not really. I haven't really gone into the full court press. I have some indices short, but I'm not in a full court press yet. I think I need to see sort of this first wave down, and then we get a bounce. Maybe that's starting now, and then we can start to press a little bit on the short side. I think right now it's a place where you don't want to take too big of risk on the long or short side. Been trying to stay fairly neutral. I'm net short, but still that to me is neutral.
So net short, that is bearish, but your positioning is not as bearish maybe as your views, which is probably healthy enough.
I took some shorts off on this down move, and happy to take. It's so hard to short stocks that you have to monetize when you can, and I did. So that's generally what the plan was. I'm happy to book some gains on the short side and reload if we get a bounce, or even if we see things move lower, I'll press lower.
Yeah. And what about your longs? What are you long? and why?
So I have a few that are sort of not brand name type things that you're going to hear a lot about. I am long I'm long Alibaba. That one is sort of just kind of languishing here in the mid 70s. They're buying back boatloads of stock every day. I think the management, there's been turnover, brought back some of the better people involved in the company from a while back. I think that's positive. They're trying to, fix things. I was very short China for a while, all the way down, and I think that the Chinese government has been signaling that they are interested in preserving the Chinese technology powers, and so I think it's a change in China that they're saying, instead of crapping all over the CEOs that were making so much money and becoming so powerful, now they're trying to embrace them and seeing that they're running a little behind with AI. And China will definitely be there with AI. And I think that Alibaba has a lot of AI initiatives. I think Baidu, which is cheap, hasn't been working great for me. I think that one will probably do okay. They have driverless cars as well, robo taxis that they're deploying, oddly enough, in Wuhan, which I guess, they've seen worse than crazy taxis running around the streets. I'm long a few catalyst type driven names. I'm long Nordstrom's. They have talked about going private. I think that will happen. At what price? It's probably not going to be a huge premium, especially if the high-end consumer is starting to slip. So I'm long that. I own it a little lower, so I'm okay there. I'm long Penn International.
Mm-hmm.
Penn International has the ESPN Bet uh, licensing rights, and I think that there's going to be consolidation in the gaming industry. We've seen it with Bally. I think you're going to see it with Penn. I think there's something there, and there was insider buying lower. David Einhorn's involved, who I think is pretty smart dude. What else? I'll tell you a couple that I really like. I'm long a company called Golar.
Okay, yeah.
Golar,
LNG.
Golar, yeah. So this company has been this sleepy company that has had these long-term contracts with their vessels that are basically floating liquid natural gas rigs that they basically float the boat up to an existing well, tap it, and process the natural gas, and it's liquid natural gas. And lo and behold, that's what they do. It's really kind of boring. But what's been happening is that they just had one of their vessels come up for new contract, because these are contracts that one was 10 years. It's now being renewed with a new company in Argentina for 20 years. And they have two more vessels that I expect to be contracted this summer, late this summer. It could be any time, but sometime this summer. Each vessel, most sell side analysts have said that it's between $10 and $20 per vessel. Stock trades around $35. Those vessels get contracted, the stock's going to be $50 from this level at least. And again, they're really sleepy type of contracts. The difference that they're doing right now is that they're taking economics rather than just contracting the vessels out. They're getting part of the profits. So if natural gas prices continue to, or they go up or stay here, they get 10 to 20% of the profits.
If charter rates, if contract rates go up, or
No, the charter rate is pretty steady, but if there's an increase in natural gas prices, actually they get a piece of natural gas prices. So if the price of natural gas goes up, it's pretty low right now. They'll make more money from these.
the price of natural gas, not the price of moving natural gas around the world on the
No,
ocean.
no, no, no.
Okay.
It's they. I mean, the crazy thing is there are a lot of countries in the world where they have existing wells drilled in the ocean floor done by the majors. And in Argentina, that's sort of a case in point where the government has said that they're going to support that and offer initiatives for this type of tapping into those wells. I think, and we just had one vessel go to Argentina. You have others in like the Congo and other sort of volatile areas that it's kind of a nice situation because rather than have run the risk of some warlord you know going jihadist on an existing well on land, they just float up to the wells, tap, and they're done. There's really long-term benefits to all this as well. And Golar could announce that they're going to contract and build out more vessels. And these are not short-term contracts, and uh, they're not short-term thinking type of companies. They will do this for 20 years. And so, as I said, each vessel is worth $10 or $20. Uh, I know they have two more that they're doing. Their contracts are out there. There's rumors of a few different companies that want to contract with them. So I think that's a catalyst right there. And when we had the latest one contracted, the stock went up. I'm up like 35% in the stock. So I still see upside from there. Okay, a couple others. There's a company called Pure Cycle,
Oh yeah.
and this is a super, and these are like sort of high risk type of ideas. Golar is not. I don't see that as a high risk idea. I think that one is easy to understand and own. PCT, Pure Cycle Technologies. Now, this is a company that is sort of a newer company, came in as a SPAC, jammed up higher with all the SPACs and then, fell to earth. What they do is that they have a plant that converts garbage and waste into purified plastic pellets. Purified plastic pellets are not the same as just recycled plastic pellets because the typical recycled plastic pellets go into planters and things that you don't use to eat with, and they're not necessarily, that valuable. But a purified one, and they have technology that was developed by Procter and Gamble in sort of like an offshoot skunkworks type of team. They had this plant and they're developing it, and the plant's had ups and downs, starts and stops, and they've really gone through a lot of the problems, and now the plant is operational and it's not at full capacity. They don't expect to be at full capacity for this year, but they will be at capacity enough and the plant running consistently enough to turn the company profitable. Now they have these plans that they want to open up 20 different recycling plants all over the world, and there's benefits for companies that want to use their product, tax incentives by using recycled products and such. And it's plastic that has been approved by the FDA to be food use safe. So that's a good thing too. So I'm not necessarily Mr. Environmentalist, because sometimes I'll come on your show and I'll say how I want to buy energy stocks. But I think this is sort of a neat idea. But here's the fun part about it from a stock perspective. There is a massive, I'm talking death wish short squeeze potential here. And it shows around 29% of the float is short. Okay, that's one thing. I've seen a lot of companies with a heavy short interest on their float. But if you take the float that I know the holders are not selling, because you have some really sophisticated long-term holders involved here, there's not a lot holding back the stock if this thing starts to get into a GameStop type short squeeze. Because again, I think that there's probably 50%, maybe 60% of the float is actually short. And if they have any sort of positive news, which I hope that we'll see some positive news, there's starts and stops in this thing. And I used to not have gray hair, but I'm just kidding. Tesla gave me all the gray hair. But if this happens, I see the stock moving higher. And again, if they can perfect their plant and fix all the problems that a new plant typically has, they're going to have 20 plants around the world. And this could be something that could be a multi-bagger, to say the least. And that's what these longer-term holders are thinking. Not only there's squeeze potential, but there's proof of concept. If they can do this, you're going to have a lot of long holders get involved. And when they do that, I see the stock moving higher. Again, there's a lot of starts and stops in this thing, but I've been squeezed in names before. And I know people like Porter Collins, who's a good buddy of mine. He was talking about it, and we know something. He was in the Big Short. We know something about short squeezes, and that I think is again. I think Charles Bronson type death wish short squeeze is there. So I think that's sort of like a one that you can put a little money into. If it works, it's going to be fine. And I really do preach, position sizing. You don't need to get bigger than 5% on any position that you have. If it works, it's going to work fine. But it's something. This is a name that I see as sort of a market dynamic, along with tree hugger type potential to feel good about.
Hello, everyone. Permissionless 3 is coming to Salt Lake City on October 9th. The event for crypto natives is heading west, and we are bringing the biggest names in crypto together for an insane, can't-miss event. Hear from more than 200 industry titans, including Balaji, Mike Novogratz, and Dan Tapiero. The conversations at Permissionless will be covering the hottest themes in crypto, including modularity, restaking, the Bitcoin and Solana ecosystems, AI and crypto, rollups and L2s, institutional adoption, and of course the November election that will be right around the corner. We couldn't be more excited about this event. Get your ticket today, and make sure I get some bragging rights by using my code FG10 to get 10% off. That's FG10, stands for Forward Guidance. I want to see you there. Do it. It's going to be at one of the most beautiful places in the United States, and everyone's going to be there. Van Spencer's going to be there. Jim Bianco's going to be there. Jan VanEck's going to be there. So what are you waiting for? Get your tickets now by clicking the link in the description and use code FG10. Back to the episode. Well, I'm surprised. I didn't know that you were involved with PCT. I've never been involved with it, but I had been following it, and there were a lot of people who I respected very well and still respect were long this thing, and I noticed that the stock really collapsed, and I don't know the details, but I'm sure they encountered financial difficulties, and I'm just reading an article or read the headline that from 2023 September, PureCycle declares force majeure following production problems. So they're attempting to do something very difficult, and they have had issues, and so the stock is really beaten down. It's down, what is it, from its peak? It's down 80%, and it was down close to 90%. But you think people are still short this name, and it's ripe for a squeeze? You think?
I'm currently up 40% in it, so I got involved in this after it fell apart. Again, I got stuck with a little bit of the wiggles on the downside. One of the short thesis stories that they had is that they had a municipal bond that they had production targets that they weren't going to hit, and that was sort of the short thesis. But the company bought the municipal bond out and eliminated that short thesis, so that sort of changed the tone a bit. Again, it's a high risk, high reward type of idea, but I look at it from the market dynamic of the short squeeze potential being there, being something that could really spook people if you're short. I mean, and I've heard from some of the large holders, and they're like, I don't understand what people are thinking here being short. It just makes no sense. I don't get it. But Again, starts and stops. It's a $7.5 stock. We'll see what comes of it, but it's starting to move higher.
What else are you short, and why are you, if you're as bearish as you say, why are you not short in size? Is it just because the market has been so aggressive going up and you don't want to get killed?
Well, yeah, I mean, not getting killed is sort of plan A. I think that what happens is in these types of markets is that you have these down moves and the buy the dip people come in and think it's oh my god, it's just a great opportunity, and then they don't make things don't work and go as high as they want, and then they make lower highs, and then they make lower lows and start to beat up the buy the dip people, and they lose faith. We're not quite there yet as far as the buy the dip people losing faith. They're still fairly active, looking for ideas, and until that starts to break a few times, I'm not necessarily being Mr. I got to press and be max short. I just don't see that. It takes time, and yeah, again, I think that it'll be interesting to see how the mega cap names are the reaction is after earnings. And the one benefit I could say is we've had a pullback in a lot of names. Like Microsoft is down a lot, Nvidia's down, Apple's off the highs. It sort of lowers the bar a little bit, but it'll be interesting to see how they react. Again, I think that it's just you got to sort of break the will of the long holders, and you're really not going to hear anything on CNBC that oh, there's real selling happening. I think that it just takes more downside for sellers to get more motivated, and that I think is ahead.
So you need stocks to go down more for them to sell, but people have to sell for them to go down. So do you kind of expect stocks to go sideways for a little bit before their big decline?
Well, we've started to see things go lower, and you're going to get lower high bounces, and then those are to sell into, and then you break to new lows. It's just it's just sort of a zigzag down, and it'll take time. And we've just started to see a little bit of weakness creep into the market. And again, I can turn around and watch CNBC, and I'm sure someone there is saying, "Oh, it's a great great opportunity to buy." Maybe, but I tend to, from my experience being in the markets for 75 years, it feels, it seems like you just want to see how things develop on the bounces, and if the bounces aren't necessarily strong, then you want to be real careful. Looking at the rotation, and that's been the big thing. Oh, we're going to rotate into the small caps. I looked at the rotation from after the Y2K and year 2000, the Russell versus the NASDAQ or the SPY. If you were long Russell and short, let's say, NASDAQ 100, you had a 40% gain. And a lot of people are like, wow, that's awesome. But it's because the NASDAQ went down 83% and the Russell went down 40%. So the problem that I see people not understanding is that both the Russell and other indices could still go down together. If you have that perfect trade on, then maybe you got that. It'll be fine. But you're most likely going to see the small caps and mid caps come down, especially if we have sort of economic weakness and consumer slowing. That's the other thing is, and I can look up on my screen up there, the Goldman Sachs most shorted basket is up 12% month to date, and the IWM Russell 2000 has high correlation with that. So you have a lot of shorts that have been comfortably short, complacently short a lot of these small cap names. So you've seen a squeeze happen. that's not necessarily sustainable without earnings. And that's the concern that I have. It's not going to necessarily make any difference if the Fed cuts one time or two times to these companies' earnings. And it's going to be even more difficult if we start to see unemployment go up. I think that's the risk. And I haven't talked about the politics right now. And I'll preface it by saying I'm an independent. I have no preference with the two candidates running, but I do think that both parties are very similar in the sense that they're going to keep spending, and one will tax and spend and one will borrow and spend. And I don't see that as a solution to the bigger problems that we have. That to me is a concern as the national debt goes up $1 trillion every 100 days. It just seems to be out of control, and the deficit is extraordinarily high.
It definitely could be out of control, but it does sound bullish, right?
Well, I don't think it's necessarily bullish, because if we're borrowing money to increase spending or it's just that's not a sustainable path.
But hasn't that been happening your entire life?
Yeah, but the problem is the numbers are getting bigger and the percentages of tax revenues are getting bigger. And that gets to a point where if we go into a recession, which I think is possible, I think it's not a zero chance. And I think that when you have the majority of people that say that there's a no landing or a soft landing coming, I'll take the other side of that. And it's a different setup for Trump going into this. And I don't care if you love him or hate him. Unemployment was at 4.9% when he came in. And, before COVID, it went to 3.5%. Now it went down to 3.4% under Biden after COVID. And it's now at 4.1%. So if unemployment starts to continue to creep higher, and unemployment, when it goes higher, it's not a short-term thing. It's quarters, it's years as well. That will hurt things. That will hurt consumer spending. That will hurt the housing market. That will have repercussions that the Fed cutting rates isn't going to help. And again, if inflation stays sticky and higher or even increases, that's another problem that's gonna weigh on things. So I see next year as a more difficult year. I will congratulate you. I watched the Steve Marin and Nouriel Roubini interview you did. If anyone has not seen that video, I think that is a must watch, because they were arguing that the Fed has been doing this stealth QE, or the Treasury have been doing this stealth QE, and they actually made a lot of sense of how it works. And I just don't know if they're going to be able to, whoever wins is going to be able to do that in the same fashion in the coming years, next year especially. So I see that as a risk. And, I like to point out a bunch of different risks. Sometimes I'm right, sometimes I'm wrong. When things change, I change my mind. But I thought that was really a great interview. And I reached out to Steve Marin on Bloomberg, and I said, just how much I got out of it, because that's one thing about you, Jack, that you elicit great answers from people with good questions.
Well, thank you very much, Tommy. So a lot of risks that you perceive. What would it take for you to turn bullish?
Lower prices.
What else?
Market. Okay, so I'm actually putting together a note for my subscribers that it's going to go into like, what would it take for me to turn bullish on things? And in 2020 or 2022, I had a really good year because I found a lot of buying opportunities. I actually traded more frequently on the long side than the short side, catching buyable dips. But I think I just need to see the market internals really start to weaken, get to oversold levels. That can be various things like breadth, measures, percentage of stocks above the 50-day moving average, in the S&P. And these are some basic ones. If you get to under 20% there, I think that's a good level to start to, pick away. I like to see DeMarc signals on the downside with buy signals. That actually does happen. It actually worked really well this year. In late December, we had buy signals in the energy sector, and I couldn't get anybody to pay any attention. And I said, you want to buy as much energy as possible. And I overweighted my portfolio with 20% of the sector with various ETFs and individual stocks. And the energy sector, shockingly enough, surprise to me, which was nice, was the best performing sector in Q1, even better than tech. And not a lot of people are, thought about that, but it really did work. So those are the types of things that I want to see. Market sentiment remains really, really high. Talked about the investors' intelligence. Market bane is very high. Positioning is overdone on the upside. I use daily sentiment index. It's starting to come down, and it's a daily index of market sentiment that I have on our site that works pretty well. So that's starting to decrease. I'd like to see it get down into 20% bulls on that. It's at 50% right now, and 50% is sort of like make or break level. Are you going to have more of a majority on the bearish or bullish? And it was at 88% recently, so that was a good sign. But I that's what's going to turn me constructively bullish. If we see valuations come down a bit, they don't have to become ultra cheap valuations. But if I get 75% of the indicators that I use turn to more, swing to the bullish side, I'll get long. And usually when I do that, I go on a program or you just talk to my subscribers and they question my sanity on things. But then again, it's sort of in my DNA. That's how I roll.
You're contrarian. It's a good way to be, especially when you're being interviewed. Tell us what other than a decline in prices for and valuations to correct would turn you bullish? What if inflation kept falling, the unemployment rate actually started to go down to 3.5%, and profit growth was 30%, and the analysts started saying that the S&P would earn over $300 in 2025?
Well, the problem in this market is that the prices would overshoot dramatically in that regard, as they have even currently with multiple expansion so high. So it would be very hard for me to chase that, and it'd be very hard for me to envision all those things happening. Maybe a couple of them, but I think that would be a challenge. But certainly I think that the move that we've had so far has created a bit of a bubblicious type move, and I think that it's a cycle. It's timing. We've had really 2 years of really strong, or a year and a half of very, very strong market action, and we're overdue. And the upside exhaustion signals on the weekly time frame, when I see that start to develop and then start to roll over as they have, that leads me to believe that we are going to see further decreases in prices and on the indices, and that is welcome by me. I'm very flexible as far as having that open-minded action. So I'd be very, very happy to see the indices pull back. We're coming into a seasonal period that's a little bit more tricky. Again, we have an election. We have two, polarized parties. I think that again, in 1999 or 2000, we had an election that was contested, and that caused all sorts of problems. But it was also coming at the backdrop of earnings starting to decline and slow, and that exacerbated everything as well. So sometimes things happen again. And, that was after a long expansion as well in the market, and maybe a more broad expansion at that point, off the lows. So I think we've had too much too fast. We'll get the market to pull back. We'll study what's going on, and get in there and buy when CNBC is telling everybody how to short stocks.
And how big of a correction do you expect? For example, right now, the mini correction we are right now experiencing is about 4% on the S&P. The one we had in late March, early April was about 5%. The one we had, from July last year, or yeah, late July to November was about 10%. But all of those occurred during a bull market. Do you think that this will be a correction during a bull market? In other words, anywhere up to a 5, 10, 15, 18% correction? Or do you think that this will actually be a bear market, which is commonly defined as a correction greater than 20%? Because 10% corrections happen all the time, right?
They used to. I think a lot of active managers like myself would be very, welcoming to a 10% pullback. I've said that I thought the market would pull back 10%, could overshoot that. I think that if we move down 10%, you're most likely going to get market sentiment readings that are going to get oversold. You could get some DeMark signals that show buy signals, and then we'll play that. But I think what could happen is then we undercut the highs and start this zigzag type period down. So I think that's kind of the thing that that's generally how I see the pattern playing out. Especially with, again, you're going to have a new administration that I think is going to face some challenges. I don't think they're going to have the ability to fund the things like with all the goodies and tax breaks or stimulus and things like that. I think that's going to be a high bar for them as well. So again, things go in cycles. They used to, and the more narrow action that we've had puts more pressure on those big name companies, big cap companies to perform and not just do good, but do great. So positioning, sentiment, exhaustion signals, all these things sort of line up for prices that should decline. Again, you've had a decent pullback on some names going into earnings next week. Next week's going to be jam packed. I was hoping to take a couple days off, but no, not going to happen.
Yeah, me neither.
Yeah, I mean, when do I ever take any time off? I mean, it's just but I also love what I do, so it's hard for me to take off anyway because I'm always looking at my phone and my wife yells at me.
So do I. Very true for me too, except for the wife part. And if ever you get tired, you said I need a vacation. It's like day 2 of the vacation, and you want to get back to work.
It's like you call in your office. What's going on? Yeah, but yeah. So I'm not at a place where I'm max short. I think it's a you got to test the waters on some short ideas at this point and see how the bounces react. I think that, again, I think people have jumped into the small cap names a little premature because I don't think earnings are going to be that great. We haven't seen good earnings. There's no reason for earnings to increase in these small cap names, especially with rates real high, with consumers slowing. I think that it's just it's premature to get involved there. And I think that you have a lot of people that have just sort of squeezed, were squeezed higher, and people that have chased a short squeeze, which if you don't have the shorts involved, and let's say that there's some sort of weakness, that creates sort of a vacuum lower where you don't have the natural buyer of a short to, cushion the blow when they cover. So that's sort of a risk in itself.
Tommy, you once told me a story but I wonder if you would be willing to tell it on this as we record right now. It was in the late 1990s, and you were at a biotech fund, or you were trading a lot of stocks that were very high beta, and you encountered Charlie Munger. Do you feel comfortable telling that story, or no?
I lived in Los Angeles. I worked at a hedge fund that was a long short hedge fund, science and technology fund, and it was a great time for those companies going into 2000 because you had the whole genomics stuff that was happening. Semiconductors were ripping, and it was hard to beat, really. Uh, but I will remember this vividly. I was at a golf club that he was a member of. I was a guest, and I ran into him, and I was like, oh my God, that's Charlie Munger. And I had always been sort of a Warren Buffett fan, and Charlie Munger fan, and studied a lot of stuff that they did. And I was, I'm a level 1 CFA pass person that I never went back because I got drafted to work at a hedge fund, and I had zero time with family and hedge fund and life. But I got enough understanding of the value process. And I told him I worked at a hedge fund, and he kind of looked at me and he goes, "You're going to be out of business." And it was really stark. It was not kind of what I wanted to hear. Like, congratulations, that's so great. I'm so happy for you. He just gave me this total Charlie Munger, like, in your face. And what I did is I went out and I bought Berkshire Hathaway stock. After that, I bought the A shares, and I still have it. And I just figured that was like sort of badass. Here I am, this younger guy, like, big fan of yours, blah blah blah. And he just was in a bad mood, and just stuck it to me. But yeah, that was that was eye opening. But he was right, because the fund that I worked at, the founder of the company passed away, and yeah, lo and behold, the fund closed, and I had to go and launch my own fund and do other things after that.
And the stocks went down a lot too because the bubble of popped.
Yeah, I mean, I look. I think there were a lot of people that were really smart value people that saw the writing on the wall, but they didn't. They were sort of just like, this is just absurd. And it wasn't that I wasn't naive to the dangers of what was coming, but it just was sort of a stark warning from someone of that stature to tell you that your fund's going to be out of business. And I was like, yikes. But it was true. He was right. So kudos to Charlie Munger. But then again, in finance, you go through these periods of ups and downs, and you learn from those and you grow from those. And I certainly did. It's embarrassing in some regard, but it was, sometimes in telling embarrassing stories and learning from them, it was good. It was humbling.
It was. As we reach a close, Tom, tell us, people can find you on Twitter at Tommy Thornton. Tell us about your product, hedge fund telemetry, and where can people find out more about that?
Yes, I am on X, or Twitter, as you and I call it still. I don't. I locked my account.
I noticed.
So,
I couldn't
yeah,
retweet you when you said that nice thing about my interview with
yeah. I'm
Muriel and
sorry.
Steven.
I did it because it's like there's so much spammers and people that do impersonations. And someone I know, I don't really know that well, but he's like, "Are you going to refund me my money on email?" I was like, "What are you talking about?" But he got scammed on that from somebody that for some, I don't know, whatever happened. But yeah, it's a cesspool on there. But if you request it and then shoot me an email at info@hedgefundtelemetry, I will approve you. I don't mean to sound like elitist or anything like that, but it is, people promising 1,000% returns in 3 days. That's what who are following me these days. But I meant also hedge fund telemetry, and I started hedge fund telemetry which is a data site. It's a newsletter. I post 2 to 3 notes a day and a few on the weekend, and that go through the week ahead. And I look at the market indicators, market sentiment. I have some trade ideas that are on there. I have webinars that I do, stuff. It's just a lot. And basically, you can reach out to me if you can take a trial. With the trials are $150. It's a month trial. I don't do free trials anymore because you know who you are. You just kept doing free trials and such. But it goes through the mindset of like what I'm looking at technically with market sentiment. I have some fundamental stuff in there, and again, my performance has been, as they say in England, ghastly. But I mean, long term, I'm fine. But I tend to look at it. I'm long short, starting to see some, opportunities arise long and short side, and it'll be fine. I'm not too worried. But reach out, shoot me an email again, info@hedgefundtelemetry.com if you have any questions. I try to educate people with the market indicators on how they work, when they don't work, and how to make money using them. Market sentiment stuff is really valuable. I had a very large hedge fund manager say that he can't live without my charts, my sentiment charts, without looking at them every day. And I thought that was cool. So yeah, I'm there. It's annual subscription. We have a special, so if you hit me up, I'll give you the special rate. And that's it. I love doing what I'm doing, and happy to have any questions, commentary shot my way as well.
Appreciate you coming on, Tommy, and thanks everyone for watching.
Cool. Thanks, guys.
Thanks for watching. Remember to check out vaneck.com/MOATFG to learn more about the VanEck Morningstar Wide Moat ETF, ticker MOAT. Lastly, forward guidance is available not just on YouTube, but on all podcast apps, and a video version is available on Spotify and Twitter, where I post interviews regularly. Thanks again. Until next time.